Hello, hello, everyone. Good evening. This
Good
is another chat
evening.
with Momvestors with my sister Nikki and myself, Carine.
Hi, everyone. Thank you for joining us again on another session of Chats with Momvestors, where we're sharing our experience of real estate, wealth building, motherhood, parenthood, everything juicy. And we hope that you continue to find value in our 30 minutes of time with you as we continue on our session tonight.
Excellent. Last time, when we wrap up our first session, we promised to talk about how do you know how much to offer to a seller if you want to buy your first property. Is that right, sis?
That's right. That's right. That's right. Yeah, maybe even a really like 5 seconds recap of our chat last time where we talked about vision and what your goals are for 2026 and dreaming big. And real estate being one of those things that scares some people, and how you could get into it and how you can get started, for us to also share our experience. And you can catch up on previous episodes on our Instagram live and on our
YouTube
YouTube.
channel. Brand
Guys, we
new
have
YouTube
YouTube
channel.
now. We have YouTube now, the NCTL Group on YouTube. So like,
Remember to subscribe. Remember to
what
subscribe.
happened? Like, follow, subscribe, share everything on YouTube. So you can catch up on our previous chats with Momvestor, where we've really shared our thoughts on investments in general and education and all of those juicy topics. So now that you've had your vision and you've set those goals and you've written them down, however big or small they are, hopefully big and bigger than you, then how do you start taking steps? How do you start taking action? And one of them is taking on that rental property purchase. And that's what we're going to discuss today. And yeah, go ahead, sis.
Yeah, no, excellent. Thank you for the recap, sis. It gives us more context. So today we're going to go through a use case. We say we're going to run some numbers. And we thought it would be easier to follow our thought process if we share examples, actual numbers, just not talking about it. So the use case here that we're going through is, let's say someone is interested to take a big step in buying their first real estate property. It could be to rent the property out, or partially rent it out and live in another part of the property. Like imagine you're buying, a duplex, you live upstairs or in the basement, and you rent upstairs or the basement, or you just buy a single family home to rent it out. That's the use case here. And so you start browsing. Typically, people will start browsing on, realtor.ca, for example, or look at signs for sale signs. Eventually, you find a property that you're like, oh, this might be it. How do I know how much to offer? We're going to answer that question tonight.
Disclaimer.
So let's get into it.
Disclaimer. Guys, we are sharing our experience. We are not coaches. We are not your mentors. We're strictly sharing our experience. So whenever you're making this decision and whenever you do decide to make this decision, please speak to your mortgage broker, speak to your realtor, your investor focused realtor, speak to the financial professionals. We are not financial advisors. Okay.
Excellent, excellent. I have to say, this is our first time sharing this. So I'm going to ask anyone from the chat to put in the chat. Can you see this whiteboard? Yes, would be helpful, please, in the chat. Is that you, sis?
No.
Okay, someone is writing on my board. You can see my board there. Okay, thank you.
Yeah.
Please don't do that. But thank you for the acknowledgement. Excellent. Okay. So they can even write on my board. But don't do that, please. Don't write on my board. Let's get into it, sis. So, what do? What's the concept first? Let's start with at least a little bit of thought process, right?
Yeah.
Okay.
So, like Carine said, you've been looking on realtor.ca. You have been, or even work in your neighborhood and you see the for sale sign up, or you see a property for sale on Kijiji, on Facebook Marketplace, whatever. Let's say it's a duplex. Let's say it's a duplex and it's listed for 500,000, for example.
Okay, so we got just before that is what are you saying? I see these duplexes, this duplex. First of all, why? Why a duplex? Why am I looking at the duplex and not a single family?
Because I've heard Carine and Nikky say, you don't have to just buy a single family. It could be a duplex, 2 units. It could be a renovated basement with a separate entrance, because we've talked about that in our chat with Momvestors. So maybe you're not looking just for a townhouse or just for a single family home, and you come across a 2 units building, a duplex, for 500,000, for example.
Excellent.
Listed for 500,000.
Listed for 500,000. This could be because I'm looking at the renting part of the property and to live in the other unit, right? A duplex, for example. Or I want to rent the 2 unit. It doesn't matter. It could apply to those 2 specific use case. Okay, so I see that on realtor.ca is listed for 500 cases. So what did we just do? We started with the end, the exit. Why do I want to buy the property? What am I going to do with that property? I want to rent it out, whether it's just 1 unit or both units, in this case of the duplex. So I start with the end. Okay. Next, sis, please. You're muted. You're looking for your mic? Okay, let me help you.
I couldn't unmute myself.
That's okay, technology. Okay.
I'm like, unmute, sis. Unmute me. Help.
I got you.
Okay, sorry. What was the question again?
So I was saying what we just did is we started with the end. We started with, why am I looking at buying this property? What do I want to do with this property? And the answer is actually what is called the exit strategy. Why am I buying the property? Because I want a property that I can rent out, or that I can live on 1 unit and rent out the other unit to help with mortgage payment, for example. So you start with we start here with the exit strategy. Yes.
That's right. And, in those 2 exits, so one being a full rental, that I want to rent out both duplexes, and the other being an owner occupied that is also rented. So with those two exit strategies, the qualification of the mortgage or the financing could be different. So when you're renting out, if your intent is to fully rent out this duplex, then you should know that the requirement for a rental is a 20% of the purchase price plus closing costs. That's the requirement for you as a buyer, a potential buyer that intended to fully rent out the property. Now, for a potential buyer that intends to live in one unit and rent out the other unit, then it's different because now it gets the property is looked at, the financing is looked at as an owner occupied residence. And for owner occupied buildings, the qualification is slightly different it's slightly different in terms of the financing, the down payment. Because at this point, the lender is looking at your income, solely your income, to maintain that building, to qualify for the building. And for a 500K, say we're buying the property for 500K, which is the listed property, which my sister is going to show us if that's what we should be offering for that property when she does the numbers. So if the property is 500K, then the rule is you can, as an owner that is going to live in the property, put down payment of 5% plus closing costs because you will be living in that property. And this is an experience that we had ourselves when we bought our first primary residence. We didn't know as an owner occupied building that you could finance that with 5% plus closing for a property up to 500,000. At that time, we waited until we had 20% before we went out to start putting offers and looking at properties. So, what you don't know, you don't know. So we hope that you guys you learn from that and don't make the same, not a mistake, but, you maximize the potential of your savings. Yeah.
Absolutely. Yeah. And quickly on the closing costs, this is anything related to hiring a lawyer or notary if you're in Quebec, paying for your land transfer or the welcome tax in Quebec. Mm-hmm. So paying for an inspection, home inspection, you need to do a home inspection. If you've been following us, you would know that. So all those costs are what is included in that closing cost, mm-hmm, on top of your down payment, which can be 20% or 5%. Okay, so that's a good tip there, sis. It's not always clear to everyone that, they can put as low as 5% depending on the use of the property. Okay, so going back to our use case, so we know we want to buy the property to rent it out, whether it's partially or full. What do we do then? What do we do at that point?
So since I know that, I think we should maybe start with the full rental at the 20%.
Yes, I agree. Yeah, option. Because this is the worst case for someone, mm-hmm, in terms of down payment, right? It's it's the maximum amount of money they would have to put here. Okay, so we go with the example where it's a food rental. We know we have to put 20% down. So in this case, 20% down would be
100,000.
Yeah. I know, full disclosure, I don't normally write like this. My writing is much better than this. Okay, so okay, down payment 20%. That's 100K. So as soon as you're going to go and ask for this financing with any lender, and they're going to ask you, what do you want to do with the property? Are you going to occupy it or rent it? You're going to say, oh, I want to rent it. And then they're going to say, oh, okay, 20% down minimum. Yeah. Okay.
Yep. And for us, typically, the rule of thumb for us in terms of closing for a property at 500,000, provided that that's what we do offer, a closing cost will be around, depending on the location of the building, the closing cost will be around 3 to 5% of the purchase price.
So I'm going to call it here like this. So let's go, if we do what? We do 3%, sis. That'll be like 15K. Okay. Yeah. So these are the costs that I'm listing. Okay. I'm listing the cost that will involve the transaction, the fact that you are buying this property. Yes. So we have the down payment, the closing cost. What else at that level, sis? At that phase, this is for the
phase of just purchasing.
The purchase. This is just that. I think that's it, right?
I think that's it. Yes.
That's the purchase. Because remember, we say in the closing costs, we have anything related to lawyers, home inspection, land transfer. We have assumed here a 3%. It could be 5%, okay?
Yep.
But we have taken it here a 3%. Okay, so at that point now, if you have this cost and you have the good financial strength, we don't want to go into the detail of lenders, you qualify to purchase the property. We're still missing some steps to make it a full rental. Okay? Now, since let's assume that, we want to do some renovations because we bought a property that needs some love, a little bit of TLC.
Then
before we get it to rental state, right? A good rental state. Yeah.
Well, so if the property needs some renovations, at this point is where you would also be estimating what you need in terms of cost for reno. So let's assume that this property needs 50K reno.
Reno, okay. Yeah. And this, again, we're getting you in your worst case in terms of first property, because you could buy a property that's ready to go.
Yep.
If it's ready to go, you don't need this reno cost. But let's say you need to do some renovations.
Yeah.
You have to find a way to estimate this. One of the ways is to have a contractor come and have a look at the property. For example, and do a quick estimate. Yeah.
And, sis, I think even just to keep it simple, we might not even need a renovation here. However, if you did need a renovation in a property that you would be buying for a set amount, in this example, 500K, at the beginning here would be where you would have accounted for that renovation cost in putting together all the money that you wouldn't need to have the building ready. So
Absolutely.
The down payment, the closing cost, the renovation cost, and that renovation cost will include contingency as well in case the prices of things change, you had to change your contractor, whatever. But to keep it simple here, we can just have ready to rent or ready to occupy duplex. That doesn't need any renovation in this case.
Okay. I mean, let's put it here. I'm going to put it as optional. It doesn't have to be, but just for our listener to know that it could be.
Yeah.
It just makes it, an extra step here. But let's say you don't have Renault. So at this point, you need
150.
115,000. Okay. And you're going to rent the property. Okay. So when you rent a property, it's to make profit, to cash flow. Okay. When we hear cash flow is king, cash flow is king, what it means is that the property has to sustain itself without you having to put money in the property to make profit. It means any type of rent that you will receive when you rent it out. So we are in this case, full rental. The rent has to cover for all the expenses and leave you with a profit at the end. And that profit is your cash flow. Because you want to make money. I'm hoping you're buying that property to make money. So, that's your goal. And one thing you know also that we haven't, I guess we're going to get there now is, yes, the lender is going to ask for a down payment. You will have those closing costs, but there will be an interest on the mortgage. Okay. Interest. Nowadays, what is the prime?
3.7, 3.8 variable.
Okay. So let's always be a little bit conservative when you run your numbers. Let's say you go with a 4%. You assume that you will get the mortgage with 4% variable, right? Sis, you say? Okay, variable. So this is another cost that goes with all these costs. So at this point, you're buying a property that is listed. It's listed. You haven't decided how much you're going to offer, but you know for sure that you will need 100K down payment because it's a full rental. You will have those closing costs between 3 and 5%. We're assuming you don't need to do renovations, and you will certainly have interest to pay. Monthly. And you know now that you're going to rent it out. So you should know how much approximately the rent will be, sis.
Yep. So we're doing a duplex.
We're doing a duplex.
Let's assume.
This will depend on the market, right, sis? Please explain us this part.
I don't know that you can find a duplex for 500K in Ottawa. So let's not even bother about Ottawa. This is an imaginary.
This is Gatineau. You can find a duplex in Gatineau.
Very old one. Then you definitely need a rental. So this imaginary city
or New Brunswick.
Where you're buying a ready-to-move-in duplex at 500K. And for a duplex that price too, let's assume they're like, 2-3 bedrooms units, very nice, well-maintained building. We can assume that each unit rents at, let's say 2,000 and 2,500 for 2,000 for one and 2,500 for the other, so 4,500.
Okay. Yeah. Go ahead, sis. Yeah, 2,500. You say?
Yeah.
For the second one. Yeah.
So that's your revenue for that building. Let's assume that it also has parking extra. So $50 per month for parking. For the 2 units, that's $100. Okay. So in the end, you're getting a 4,600 rent.
Okay. Parking. $100, as you say?
Yeah, $100 a month for the 2 units.
Total. Okay. So that's your revenue.
Yep.
Yeah. So at this point, you know your expenses, your income, your revenue on this property, right?
Yep.
And you know you want this property to cash flow, to make a profit. How do you know how much to make in terms of offer? There are two things here that you will consider. You will kind of go backwards. You know those rents are there. They will rent at this based on the market. Like my sister said, depending on where you are, the rent are the market rent. There's nothing you can do there. You have to follow the market. Otherwise, you will not be able to rent out the units. If you go like crazy, if you go in a market of a 2,000 rent and you are renting at 3,000, no, it will be difficult. The unit will stay vacant. So you have to really follow the market. So you know how much are the rent. You know how much will be your cost. Based on that, you can say, okay, everyone has their own level of, I want to call it goals in terms of profit. I can decide that I'm okay to have, for my duplex, to have a profit of $100 per month. My sister Nikky can say, oh, I would rather have, my goal is to have $150 per month as a profit. And again, this is based on our vision board, right? Our goals, because we are buying this property to be consistent with what we want to do this year with our goals. So you have a goal and you say, okay, based on my goal, I want this profit, my profit to be at $100 per month. Based on that, if I assume that my rent at this per month, and knowing that I'm going to pay those interests at the bank and my mortgage, so let's put a number on these total expenses to be clear on the illustration. So revenue per month, that 46. Okay. And I say that I want, for example, I'm good with a profit of $100. Okay. I'm good with that, a profit like that per month. It means if I'm assuming a revenue of 4,600, that's going to pay for my expenses and that give me a profit. Those expenses should not be higher than $4,500. Because remember, I want to get my rent. I want to be able to, for my rent, all my income, I want all my income to pay for my expenses so that I have $100 left as a profit. So I know this is the maximum in terms of expenses that I should have on this property. Based on that, I'm like, okay, if this is the maximum, this is per month. Remember, this is the maximum. The bank will tell me, remember, we don't have this, we don't have the renos. The bank will tell me, if you give me a down payment of $100,000, the closing costs you have to pay them, that's not the bank. And I give you an interest rate of 4%, they will do a calculation. They will say, okay, based on if you want to purchase it at $500,000, this will be a mortgage of, I don't know, they will say $3,000, for example. Plus you have to pay for the property taxes and the insurance on that property. So
we should list the expenses. We should list the typical, we don't have to put numbers to them, but the typical expenses that people
Okay.
will have monthly
Like a, yeah. Okay. So let me
to
do that.
maintain the
The
rental.
property, yeah. You're
Mm.
right to write it down. Okay. So the expenses on a typical property, you
Yep.
have to pay for the mortgage, of course.
Yep.
You have to
Mortgage payment,
pay
the
the
insurance.
insurance because you have to insure your property
Mm-hmm.
and the property taxes.
Right.
Those are typical expenses.
Yep.
You also need to have a little bit of
Reserve.
reserve for maintenance. For example, something breaks into the property, a furnace, God forbid, you have to change a roof. Anyway, some sort of reserve.
Yep.
So basically what I'm saying is that for a revenue, if you will have a total revenue of 4,600, your goal, if your goal is to make 100, and you have these expenses, you're going to ask yourself and say, okay, with those assumptions, it means my expenses, if I buy this property, I have to buy it to a price where my expenses do not go above 4,500. The way I did it is I know I have a revenue of 4,600. My profit, $100, is supposed to be my revenue minus all my expenses, and that's supposed to give me 100. So if I want 100 as a profit, it means my expenses should not be higher than 4,600 minus my profit, which is 4,500. Now, my expenses, I will know how much for the insurance. I will know how much for the taxes. I will also know how much in terms of reserves I'm comfortable with. The
Mm-hmm.
bank will tell me now the thing that will change based on this, the purchase price now is this, the mortgage payment.
Mm.
You want to explain how it's going to change this? Because that's the final thing here, the most important thing.
Yeah, and it doesn't have to change if, like Carine said, your expenses is lower than your revenue and you have your cash flow, your targeted cash flow of $100 and you're making that. Cool. Place the offer of the 500K because the property is cash flowing.
Yeah.
However, if your revenue is still the 4,600 and your expenses now turns out to be, say, 4,800, now you're at a negative cash flow, a negative of $200. This will be the point where you have to either reduce how much you're offering for that property or increase how much you're putting down as your down payment. Our goal is always to reduce the purchase price, the offer of the purchase price. If it works for the seller, of course, we always try to create a win-win solution where the seller is happy, we're happy, we have a good relationship. Awesome. So all of this is you're buying a duplex that will be fully rented, that you need to invest 115,000 yourself, plus whatever renovations or not that the property may need. You know what your revenue is for the property, which is the rent, whatever the rent is, and you know what the expenses are, which usually costs that you would in your due diligence have already known before you put in an offer on the property. You would have calculated the mortgage because the bank will tell you, or you use a mortgage calculator online. The insurance, you can always reach out to an insurance broker. They will tell you what the insurance could be for that property. The property taxes, the seller would provide you with the property tax, the previous year's property taxes, or the current year, depending on what time of the year you're looking to buy. And then your reserve, we have the vacancy. There's usually a set vacancy rate in the city that you're looking to buy. Like Carine was saying, in case a furnace breaks or roof leaks or whatever. So you have those additional reserves that you want to put, because you don't want to put yourself in a situation where you're having to then take money out of pocket to sustain this building, especially when you're just bought it, when you can control all of those variables from the beginning by adjusting your purchase price.
Excellent, sis. Thank you. So yeah, that's how you figure out, how much you can offer, even if it's listed at 500K. If that 500K makes your mortgage payment a number that makes your expenses higher than this maximum number, well, it means it's not the right price for you. You cannot afford to offer that price to the seller. And one thing also, another check that you can do is to make sure that whatever your numbers also, that you are looking at comparables. That's another thing. It says comparables in the area. Similar duplexes, similar market, how much are they selling for?
Yeah.
Because even if one thing as an investor, we always want to pay the right price, or actually under a little bit, always under. Okay, so even if the 500K is good, you're cash flowing with that, but you find out that in the area, duplexes are selling for 450, you should definitely go with your 450 first as a first offer. Because guess what? If the 500K gives you your profit of 100, your targeted profit of $100 per month, 450 would be even better.
Even better. Yeah. Yeah. And your realtor can help you with those comps, because, some people might wonder, how do I know the comparables? Where do I find that information? Your realtor, whatever realtor that is representing you for the purchase, will be able to pull, they have those data. They will be able to tell you in the last few months, up to like 3 to 6 months, these are the prices that duplexes have sold or listed for in this area. So, this would be a good amount to offer. Just looking at the time, we're a little bit
over, but it was a good one, sis. It was a good one, I think. It was much needed, because that's really a fundamental. You can apply this whatever you want to buy. The same concept, right? I'm looking at my exit strategy. What do I want to do with the property? How much is it going to make me in terms of revenue, rent? How much do I have to keep to maintain the property in terms of expenses, my carrying costs, and how much do I want to make? What is my target goal, profit goal? It's the same principle.
And the amount that you need at the beginning, in this case where the property is fully rented, you needed the 115K. However, if you're thinking of an owner occupied where and it doesn't have to be a duplex, it could be a single family, it could be a townhouse, whatever it is. Maybe you're just a couple, where this was what we did. We had a townhouse with multiple bedrooms, and my husband and I were just in one room, Airbnb in the other 3 bedrooms in our home. And for Carine, as we've shared in the past in the chat with Momvestors, she lives in the upper part of her home and invested in converting her basement to an additional dwelling unit, and now rents that house so that it, again, reduces your monthly expenses.
My mortgage payment absolutely helps. It's a mortgage helper. Absolutely.
So this has been, even for me, I'm happy to see these numbers out here. So I hope that you guys have learned 1 or 2 things from this session. And for the next session, we're going to get into our closet. Carine. And what I mean by that is this right here is an example of, the smaller buildings for a first-time home buyer, for a first-time investment property buyer. However, for us, where we're doing more of a land development project here in Ottawa, we will be talking about how this applies to land development. How do we choose the property, the land that we choose to build on, the property that we choose to demolish before starting an infill development? How do we analyze the sale? How do we analyze the purchase of the land? What are the other variables that we consider? Because right now you've only seen the variables of the revenue and the typical expenses. What are the other variables that are considered for us? What are the regulations that we consider before even choosing a land or a lot in a neighborhood? So these are the things we will be discussing at the next chat with Momvestor in the next 2 weeks. Again, it is bi-weekly on Tuesday nights at 9 p.m. This recorded session as well will be on our YouTube page. Again, look for us on YouTube. Like, share, and follow or subscribe, whatever. Subscribe. I think it's called subscribe on YouTube. It's not called follow.
Yeah, anyway, I think it's subscribe, yeah.
Look for us on YouTube and follow and subscribe to our channel. Oh my gosh. To our YouTube channel.
What's the name of the channel again, sis?
The NCTL Group. Look for us, the NCTL Group, and it will be Chat with Momvestors.
Excellent, excellent.